Let's get a move on and connect then with Amnish Aggarwal, who is joining us on the show right now. Amnish, good to have you on board. The markets may have taken a bit of a breather yesterday after 2 days of a stupendous rally, but it was the IT sector that definitely stood out, hitting record highs. What's the sense that you're getting as to how much further this rally can sustain within IT?
Yeah. Hi, Van. You see, as far as your IT sector is concerned, there are two things. First of all, with the US elections getting over, now people are getting more comfortable that the IT spending will likely start and they will get more clarity. Secondly, the kind of fear people earlier had that once the Trump administration comes, there would be, you can say, much more embargo on H1B visa and all. I think that is not going to be there. So there are pockets within IT where you are still having some stress more in the, I would say, some European markets and all, like here and is not doing well across segments. But broadly, given the fact that the valuations today are much more reasonable for frontline IT stocks and the visibility is improving at a very, I would say, steady pace, not at a very sharp pace, the IT today represents a segment where I think you can say the downside is very limited and there's a scope to make steady returns incrementally.
Okay, fair enough. Meantime, we've got the spotlight as well on M&M. There have been some new launches coming in. Brokerages seem to be quite upbeat. Would that be one of the stocks that you would tilt toward within the auto space?
You see, M&M is a topic in the auto space. And it is not only because of EV. It is because if you look at the entire PV space today, M&M is the fastest growing company. With I would say 15 to 17% kind of a volume growth even in this current depressed demand scenario. Even the tractor demand has actually bounced back this year with monsoons being normal. Now, when you come to EV, I think EV, if you look at the companies are launching products across segments, you look at, for example, your Tata Motors, you look at some of the other players. So EV as a segment is not something which is growing very fast, at least from the last, say, 2-3 quarters. But having, you can say, presence over there, it becomes an essential part and it will fill in the big gap which is there in their portfolio in terms of, say, scaling up this segment. So M&M, I would say in the entire, if you want to play the PV space, if you want to play the entire auto space, I think M&M today seems to be the best placed stock.
In fact, Amnish, would like to get in your thoughts. How are you looking at some of these cap goods majors stacked up against each other?
You see, cap goods, if you look at the recently concluded quarter also, this is perhaps the best performing sector in terms of numbers because the profit growth of all the cap goods companies, even the order books, they have been looking quite decent. So in the cap goods space, say for example, if you want to pay the entire this year automation electrification theme, then the companies like Siemens, ABB, and to some extent even your GT and the Schneider, etc., they stack up there. And I think among these, I think ABB and Siemens seems to be the, I would say, the largest and very formidable players. So Siemens seems to be, you can say today, having all the segments under one roof, whereas ABB is more, ABB doesn't operate into, say, your transformers, HVDC, etc., where Hitachi Energy has come in. But I think if you look at the pipeline, if you look at the kind of momentum which is building up, if you look at, say, the power requirements, then an entire energy transition which is happening, I think some of these stocks, they will continue to show very decent profit growth in the coming few years. So Siemens, I think it's also going to, you can say, you're split into two companies. So Siemens Energy will also be separated from this. So some value unlocking will also happen. So I think from a medium term viewpoint, if you take say 2-3 years kind of a view, then I think all the, you can say MNC companies which are into, you can say this vertical, I think they should continue to do well.
Mahindra and Mahindra is just firing, full cylinders. First, a great success of XUV 500. Then they come up with a Thar. Then a modified version of Thar. Then a SUV which is priced at 12 to 13 lakh. And just before everyone realizes that, okay, Mahindra and Mahindra as a company has really reinvented themselves, they have surprised everybody with this real exclusive launch of some classic looking EVs. Where is that stock headed? I mean, I look at the valuations, I look at the market cap, 3.5 lakh crore. Do you think markets would continue to re-rate this stock further, considering that how much of head start they have in the SUV market now?
Yeah, Nikunj, as we discussed, I think 10 minutes back only, that M&M actually, if you ask me, they have got the pulse of the Indian consumers right. If you look at 5 years back, M&M was considered as a very lazy company in terms of the total, say, product innovation on the PV side. But the way they have come up in the last few years, that is certainly amazing. And the way they are now changing their products, offering best of the features at very competitive prices, I think if the volumes continue to behave the way they are, the way, for example, the entire you can say range of your SUVs has performed. Even now Thar is doing well. 3XO came, and now these EVs. I think if they continue to give you good volume growth like this year, that they are perhaps the only large company with double-digit volume growth. So if they continue to grow like this, they continue to launch competitively priced new products, I think the stock, you see, in terms of P multiple today, they might be trading at a premium to where a Maruti is trading. But this premium can sustain for a much longer time if the growth continues like what they have been doing at least from the past couple of years.
The general view, for the market right now, Amnish, is we are in for a good December. Lot of news flows behind us: earnings, election, China, Trump, dollar. Do you think markets, in a sense, have dissected and digested and have in a sense accommodative all the news flow which was thrown at her? Because from October to November end, I mean, it's just been about festival season data, then elections, then US elections, then a state election, then China, lot of news.
Yeah. So if you look at say last in particular, we have had a spate of negative news ranging from say your higher inflation, poor demand, and all the election-led uncertainty was there. So I think most of the negatives are now getting, I would say, they are getting addressed in, they are getting priced in, and I think the only factor which we need to watch out for is that the inflation comes down sooner than expected, because that will actually pave the way for an interest rate cut in India. Otherwise, I think in terms of say political stability, we are now much better placed. The global geopolitical headwinds are also expected to abate over a period of time. So I think all the negatives are now getting priced in, and the market should slowly start now, you can say, building in positivity.
Let's get in a take from you, Amnish, as to what the outlook is on the entire food delivery platform space. Pretty positive brokerage notes that have been coming out on the likes of a Swiggy, talking about how it's available at a discount to Zomato, but they are competing in the same market. What's the outlook on how you're reading into that very competitive space?
You see, food delivery is now more like a stable growth scenario. They are not going to grow anywhere, say 50%, 70% kind of number. It is going to be more normative, 15-20% kind of a growth. And definitely it's a consolidated market with Swiggy and Zomato being the two major players over there. But having said that, today you see one of the major arguments in Swiggy is that the market cap of Swiggy is much lower than Zomato and it is available at a discount. So one can presume that Swiggy today is where, say, Zomato used to be a couple of years back, and everything depends on how the execution goes and how they ramp up their market shares and they turn towards being profitable. So that is what I think you can say the market is betting on in terms of Swiggy. But definitely how you can say the entire story in your quick commerce pans out, that is the key to both Swiggy and Zomato, and not merely what happens on the food delivery side. Because today, in terms of valuations of the value, the bigger chunk is coming from the quick commerce. And in quick commerce, I think with Zepto and Swiggy now having got, you can say, additional funding, I see, and some of the other players, whether it is a Flipkart or Amazon or Reliance trying to enter this place, I think it is going to be highly competitive for the coming, say, 6 to 12 months. So in terms of, say, valuations, I see there is no much scope for re-rating unless until the companies start showing some sort of, you can say, significant improvement in their profitability and they are able to sustain growth. But this area is going to be highly competitive, plus the way they are growing, and there are some, you can say, talks about they are eating into the share of the mom and pop stores and kiranas. So that is another front where they can face some challenge actually over the coming 6 to 12 months.
Swiggy versus Zomato or Zomato versus Swiggy, that good old debate I think is now on. I just like to draw everyone's attention to value retail. While quick commerce is growing, value retail stocks in last 1 year have done nothing. V-Mart, D-Mart, I can only think of two actually. Trent is also technically value retail, but yeah, I mean V-Mart is classic value retail. If one looks at D-Mart, it's been a linear decline for D-Mart. Then the other group where we've seen stress because of slowdown in consumer, I think clearly seems to be this entire QSR space. A couple of QSR names, they had a great debut post-COVID. Devyani International. Devyani International, by the way, is the same promoter group as Varun Beverages. Jubilant Foodwork, 14-15% higher, even though they've got their mojo back. And then you got Restaurant Asia, done precious little. Restaurant Asia, I think, owns Burger King. Let me check, I could be wrong, but I think they own Burger King in this. What is your view on some of these QSR stocks, Amnish? Do you think the tide could turn for value retail? Quick commerce is overhyped, and now it's time to look at the other side, which is value retail. Maybe look at QSR, get out of hotels and look at QSRs.
See, QSRs today, they are depressed lots in terms of say numbers and in terms of where the stock prices are. Maybe you can exclude Jubi for a moment from there. And the reason is that there's hyper competitive intensity which has got into the space. You have got much more number of players which have entered the space. And if you look at say all the companies barring Jubi, which reported 2.5% like for like growth, all the companies are into negative SSG territory. And the way the things are stacked now, some of them are citing say some geopolitical issues are there. You can say competition is there, slow consumer demand is there. So I think it will take a little bit of time for QSRs actually to bounce back in terms of performance. In terms of stock prices, many of them might be close to bottom or maybe within, you can say 10% standard deviation of the bottom. But in terms of their getting into, say, profitability or the numbers or the growth paradigm, which was visible, say, a year and a half back, I think all the companies are way off. Most of the companies, many of them have gone into losses. Some of the companies, even in FY25, will report EPS lower than what they had in FY23. So I think at the current juncture, it is only a space where you can say the people who want to play contra, assuming that the stocks are available at lower levels, they're ready to wait for one year or two. So I think this is a space which is better suited for that kind of, you can say, investments. Slightly bit of contra at this point of time, I would say. When it comes to value retail, you see every segment, for example, the factors at play in V-Mart, they would be different because it is more like a tier 2, tier 3 player than in comparison to what has happened to Avenue Supermart. But definitely somewhere Avenue Supermart also got a hit from what a Trent or a V-Mart were doing on the value retail side in apparel. And then obviously the onslaught which has come from quick commerce. So I think some of these stocks, for example, Trent at 3,600, I think the stock has fallen a bit too much. But is it cheap? Still, the answer is no. Many of these stocks are not cheap, but everything will depend upon how the growth pans out for the next 3 to 6 months. If some of these companies, they bounce back in terms of growth, then you will see that some of these stocks can easily give you, say, 20% return from here. But if they continue to disappoint in terms of numbers, I think they can have much more sideways movement, particularly, say, for the stocks like maybe Avenue Supermart. But in terms of the other tier 2, tier 3 value retailers like V-Mart, etc., I think with the demand improving in the rural tier 3, tier 4 kind of an environment, I think these companies will start witnessing some sort of an uptick in terms of their performance.
Where is it that your preference lies within the large cap banks? We've been talking about HDFC Bank finally proving its mettle. What's the pecking order here?
You see, in the large cap banks, we actually prefer ICICI, HDFC, and followed by Kotak.
All right, going to let you go on that note. Thanks so much for joining in.
If you like this video, then like, share and subscribe to ET Now.